Gives me great pleasure, and sometimes word cannot capture how excited I am to have Mr. KV Kamath on ET Now as part of India Revival Mission. He is one person in my professional career I have interacted with him in different avatars. As a banker, as a visionary, as someone the world looks up to understand which way not only the economies are moving, which way the financial sector growth and what are the important regulations and rules which need to be implemented so that globally and locally the financial sector remains vibrant. Now, I've always introduced Mr. Kamath in very different avatars, but today I would like to introduce him as chairman of RBI Committee on Loan Restructuring and former head of the New Development Bank. Mr. Kamath, what a pleasure to have you back on ET Now. Thank you so very much for your time.
Thank you, Nikhil. Delight.
Mr. Kamath, first allow me to start with the big picture and perhaps an obvious question, which is that what is your understanding of the world? In the month of March and April, when the COVID crisis was at its peak, it appeared that we could be in for a very large period of protracted growth and fear, but things are normalizing now. What is your understanding and how would you share your worldview with us?
Actually, I'll also go back to March or so. I remember a meeting of the heads of multilateral development banks, and we had every meeting with multilateral development bank in the world, and the view was a totally negative view, and the response was that there will be the refrain was that there will need to be massive balance sheet restructuring around the world. I don't think that view has come true. It is clearly there is pain, there is a revival required, but the sort of fear of massive balance sheet restructuring that was expected at that point in time, I'm talking of mid-March globally, is not transpired. So things are coming back to the new normal quickly. And that's the overall worldview. And very interestingly, India is also keeping in sync with that. Things are coming back to the new normal, as it were, quicker than I had expected.
What is your view on the way how India is handling the COVID crisis? Because Indian government was the last one to announce a fiscal package. We followed a differentiated strategy. While globally interest rates have plummeted, they've almost come to zero in various economies. In India, things are very different. Do you think in hindsight, when we will look back and understand the monetary policy of RBI and the economic policies of the government, will that be a mistake or will that be conservative but a differentiated one?
No, I think if I look at it in context, the context that I would look at is what was then the dots that were visible. The dots were when we went into the lockdown and provided the package. There were a few dots that were available, and we had to work within that scope. So at one end you had the China model, which was a complete lockdown. And it was a very tight lockdown. And probably for that reason, it succeeded. Now, we had a lockdown which, for a very different reason, had to be porous. And I won't go into that. And that clearly meant that you kept the economy going, you put food in the hands of people, and so on and so forth. So a completely different model to what we would have otherwise had. So I would think that our model is a India-centric model. It was meant for India, and it has worked as an India model going in the last few months, as it were. Now, coming to the steps taken by the government, it's a large package that has been put on the table. It's been very innovatively structured. I think the structure is like I've seen nowhere. It is large. It, at the same time, doesn't put strain on the fiscal. It leverages strengths that were there. For example, the food grain stock that we had. It leverages the liquidity that was in the banking system and provides a gentle helping hand to make sure that these reach the places where it has to be reached. And so far, to me, by and large, it seems to have done its work. Yes, there is some more residual work in terms of how do you look at companies which are in distress and so on. And that, I think, is being addressed by the Reserve Bank of India. All in all, I think this is a very, I would say, innovatively structured, thoughtfully structured package that was put in place.
Mr. Kamath, all banks have used the benign liquidity to raise capital. Is that a telltale sign that they are simply worried about the way how moratorium and NPAs would move, or banks are playing it safe? And like Mr. Kotak said, it is, we are trying to raise capital so that the boat does not rock. How should one understand this? Because if banks are raising capital, Mr. Kamath, minority shareholders would say that that would have impact on return ratios at least for next 2 or 3 years.
The latter view, that will have an impact on certain ratios, I think to me is a short-term view. Bank should always take care that it is adequately capitalized. And I think this is one of the principles of governance for a bank, that you have capital in place. Because after all, in today's banking, what are the 3 capitals you have? You have financial capital, you have human capital, and you have technology as capital. It is the interplay of this, bound within a governance context, that makes a bank tick. So if one of these, and in this case you're talking of finance, is judged to be could come under challenge, I think in advance, proactively raising capital is always better than raising it retroactively. So I would actually compliment the banks for having raised capital, whether they need it or not, because we are in an unpredictable situation. For example, based on numbers so far, based on steps taken so far, quarterly results that we have looked at, most banks are still fairly well capitalized. But we do not know what the turns ahead are. And it is better to adequately shore up capital at this stage and not read too much into it in a negative context. That banks are doing this because they read something. I don't think anybody is in a position to read anything today. It is just good sense, good management that the banks are raising capital. And I'm happy that if 40-50% of the financial sector de-risks itself by having adequate capital, the other 50% or 60%, which is basically the government is the majority shareholder, can very quickly come up to speed on this. So the steps taken, I'm very happy about.
When I started my career, you were with ICICI Bank, and that time growth and market share gain was really your mantra. 20 years henceforth, when we take the clock forward, looks like things have beautifully fallen into place what your vision was, let's say 1999 and 2000 and 2001, when you said that private banks will become large, India will have a vibrant financial sector, and India will have big businesses, especially insurance, credit card and others. Where do we go from here now?
Nikunj, that's a beautiful question you asked. My response is very interesting. My view is that the banking sector has probably traversed 10 to 15% of its journey. Again, it may come as a surprise. My belief is there is 85% still to be achieved in terms of scope, scale, size, and what the banking sector can do. How do I say that? Because I'm not looking at the India of today. I'm looking at an India 10 years hence. A 5 trillion economy, going to a 10 plus trillion economy in 10 years. And, if that happens, it is not that banks will become threefold or fourfold in size. Banks will probably grow at double the. So you're really looking at a banking sector which is not threefold or fourfold, but probably is eightfold to tenfold the size of the current banking sector. So the dimensions of this banking sector that we're looking at today are going to be completely different from what it will be 5 and 10 years from now. One. Second, even more exciting, is the change in, I would say, the nature of or the character in which we will do business. We did business starting in 2000, leveraging technologies that were available then, and then painted a picture of the future. I think if we were to paint that picture today, I think you're going to get a completely different picture. This is a picture where you will have the digital world basically accelerating at a speed that we never looked at. I'll give one point of reference. In 2000, I used to always say, we go by Moore's law. If the power of computing is squaring every 2 years, you can afford to grow at that pace, and still technology will be affordable, technology will because costs were also dropping at the same pace. So technology will be powerful enough and cheap enough. You can grow. Today, with AI, the power of AI is increasing at a tenfold pace every year, not at a square every 2 years. A tenfold pace every year mean that I'm talking about the price performance ratio. So your costs are dropping. Where you thought AI was not going to be cost effective because it was a heavy front, it's not going to be so every year that passes. So if I look at 5 years from now, we're living in a world where 5G is present, where virtual becomes real, and you're looking at a world where change is going to happen in the blink of an eye, and AI is going to be a key. Now, if it is the banking or financial services sector, any player in this sector who embraces all these things is going to be a winner in this new picture that I'm trying to paint in my own mind. This is my own perception as I look at technology, as I look at scope and scale. Now, and this is not only in India, because a lot of these changes are yet to happen around the world. And there is no lag anymore. Earlier on, technology came somewhere else. It took a year, 2 years, 3 years, initially 5 to 10 years. Then it became shorter and shorter. But now it is coterminous. When there's a new technology somewhere, our Indian technology partners are able to bring that to the table. So the financial services sector will probably be at the cusp of changes that will happen. Be much bigger, as I said, scale-wise, 10x, 8 to 10x in size, and technology-led players.
Mr. Kamath, allow me to address something which is of immense market curiosity right now. And when I speak to people about their view on moratorium, Mr. Kamath, I'm saying in all sincerity, people are nervous as if they are preparing for IT exams or board exams. Do you think markets and everybody should not be nervous about moratorium window when it will get lifted in August end?
No, let me put it this way. I think there are three parts to this question. And I am looking at it as an external observer at this point in time. First is the steps taken by the Reserve Bank of India, Moratorium 1 and Moratorium 2. I think they were they were timely, well executed, and I think have served the purpose. Second is what happened between Moratorium 1 and Moratorium 2. The numbers corrected in a way, in a positive way. So that also tells you what the situation is. Third, unrelated to the steps by the Reserve Bank or what happened at the banking end in terms of moratoria, is where do we see companies at this point in time compared to what they were 3 to 6 months back. My own perspective, and at this stage I'm not going into the balance sheets or the P&L of the companies from the first quarter numbers. We probably need to see not just 800 companies that have probably published numbers so far, need to see a bigger number to come to any conclusion. But having had in my mind, I had a picture of where we would be 1 quarter down from March. That was a dire picture, Nikunj. I don't think the picture is dire as we thought it was. What is the dire picture? The dire picture was the question, can industry at all start in 3 months' time with the lockdown 1, lockdown 2, and the conditions that were put to open up businesses? Not only business, but then you have to get the supply chain also going. Whether we would at all be able to kickstart the economy. But I think everyone would agree that today when you look at the performance of companies getting their own businesses up, they may be working at anything between 60 to 80 or 90% capacity. But to me, that was not to be. I thought that they would be still struggling to open. The supply chains are in place, which means that the supply chain, basically, the components of it are our MSMEs. So they are coming in play. And then, of course, you have the distribution channel that is happening. So I believe that we are at a much better place than we were 3 months ago. And this fear of what happens to moratoria after August, I don't think is there. Let me put that in context. Today, our bank lending, what is it? About 40% is retail India. Now that banks have an opportunity to hit a reset button through what the Reserve Bank offered on August 6th. It is now up to the banks to act at speed to do that for their own health and the health of their customers. Now, here again, if you look at the customer, these are all performing customers as on a particular record date, which was just before COVID started. And to that customer, I think a 2-year reset should be more than enough to handhold him through the current challenges that he's got. That is the retail. You look at the corporate book, you then have packages that have been given to various groups of lenders. Agriculture has had a package. MSMEs have had a very large package. That left a large part of the rest of India, the corporate side, the infrastructure side, to be attended to. And I think that is what just now, through the August 6th guidelines that Reserve Bank announced, and by September 6th, they want to announce the operating conditions for this. I think we should have something in place which should then tide over that part of. So by and large parts of the players in the system would have been addressed. So the market should not have a worry of post the moratorium cut-off date, what happens. I think the Reserve Bank has acted very timely, in a very appropriate manner. We can expect that the banks and their clients will continue to stabilize as we go along.
So, Mr. Kamath, since RBI governor has said that 6th of September, the debt restructuring contours would be announced, I am assuming that your panel has already submitted the report because we are already in August end now?
No, the panel is working. We are working overtime. We had initially 2 meetings a week. 6th August, and then getting it going took us a few days. This week we will have 3 meetings. Next week we will accelerate it if possible. Somewhere next week we should, before the due date, we will certainly submit the report by working at extra pace as necessary.
Mr. Kamath, let's talk about the government's attempt to reboot the manufacturing sector. When I speak to manufacturing companies, they have 3 issues: cost of capital, labor laws, and cost of land. The latter 2 are getting addressed, but let's address the first one, cost of capital. You understand the banking system, sir, and you now have a first-hand experience of understanding the Chinese banking system. Why is there this huge disconnect between what the Chinese bank rates of lending are versus India? What can be done to make sure that the cost of capital actually gets passed on to the Indian corporates here?
This is, again, a sensitive question. It is a question which is absolutely critical to us going forward. It was critical to us in the past. A large part of our problem, Nikunj, are due to the high cost of debt historically. Historically, when the correlation between inflation and interest rates was, I think, very, very tight, we had no option but to respond, because there weren't too many policy instruments at that point in time to counter inflation. So the only medicine that we had with us in the dispensary was to correlate inflation and then inject high-cost interest rate as a therapeutic for that. I think this large context, a country like China gave away many years back, and Southeast Asia gave up many years back. So today, I'll give a great example. If you look at what happened in 97 or 98, when there was a currency crisis in Southeast Asia, inflation was in the 20%, 30% range. I remember going to Thailand, inflation running at, I was at the ADB those days, I think. Inflation going back, or I'd just come back to India. Inflation at 20 or 30%. Interest rate single digit, mid-single digits. So I would think that some countries have been brave to disconnect these two and then find their footing, as it were. Coming to China that you mentioned, interest rates are at 2.5%. Lending rate for a prime customer is 5%. It does 2 things. One, the business is much more competitive than what you are if your customer is borrowing at 8 to 10%. A. B, I think if your interest rate is 5%, and our interest rate is 10%. At 10%, your NPA will double every 7 years or 7.2 years. At 5%, probably it will take what? Double of that. So 14.5%. So you get a couple of cycles, business cycles, whereby the asset can be put back to productive use. And that's exactly what has happened in China. So twice from 2000, or thrice now, they have been able to put back assets that became NPA to productive use to this. whether it is real estate, whether it is manufacturing, whether it is infrastructure. Well, in our case, given the speed at which the asset corrodes in the context of the NPA value of it, because of interest rates that we carry, so the whole thing becomes unproductive in a way. So double whammy, you have an issue with the high cost of manufacturing because interest rates are high, and then God forbid the asset becomes unproductive because it becomes an NPA for whatever reason. Thereafter, then the carrying cost becomes prohibitive in your hands, and you have a challenge. So I would think that in a growing economy, where you have other ways in which you could combat inflation, I think this whole set of equations should be looked at in trying to address this issue, so that industry has breathing room to produce at a competitive rate, and then to survive also at a competitive rate. And that survival means the industry survives and the lenders also survive. And the last point here, for Atmanirbhar Bharat, I think getting the interest rate equation right is going to be a key part of how we will do on Atmanirbhar Bharat. I think it's absolutely a doable concept, the concept of Atmanirbhar. I think this one equation has to be also simultaneously addressed.
And before we wrap, Mr. Kamath, I have to ask you that what's been your biggest personal experience in this entire COVID crisis? What have been your reflections? When was a day when you thought that, oh my God, everything is over? And what was that moment when you said, look, this is the best opportunity in last 100 years for an entrepreneur, for a businessman, and for an investor?
Yeah, I think the mood was exactly as you said. The mood transfers through those three levels. I think initially there was a panic response, I would say, the fear or flight, fight or flight response as it was. How do you respond to this? Because no avenues seemed open, because we went to lockdown one, supply chains, and we weren't sure whether going to be active. Then you had the second round of lockdown, and no sight as to when it would open. You know, the first mood change came out very interestingly in the economy. It did not happen at the business end. It happened at the home end, because you had to set up a supply chain for the home. And I raised a salute to the women of our building. We have 70 apartments or so. They all came together and set up the supply chain. Initially, it was crude. It was WhatsApp, payment by cash. But within the space of a week, it moved into Google Sheets or Excel Sheets, digital payments. Within the next 3 or 4 days, the supplier had gotten an app going. And digital payments. Supplies, of course, delivered to your security gate. So the transformation and the acceptance of new technology by lay people, housewives sitting at home, not exposed to technology, ability to manipulate a Google Sheet, manipulate an Excel sheet, get onto that digital platform for paying, and set things right, I think for me was the first eye-opener. And I thought to myself, if we can do it at home, and the women who have been not exposed to the corporate world can do it almost like a corporate world is going to do it. No, I think the corporate world then was able to do it. So mood transformed at that point in time to, yes, we can. And clearly, as days went by, I heard more and more positive signals coming from corporate India. This is one. The second part of it is very clear now. The way digital has been embraced, the way technology has kept pace, the way you are able to do things using technology yourself, my view is that there is a complete and total reset, unlike anything that we have ever seen before. It is forced on us, and the acceleration has happened because it is forced on us. And we are all forced, from the home to the largest corporates, into what I would call a digital super cycle. We are now spinning the wheels of that digital super cycle to get in front. And that gives us tremendous momentum. Whoever is fastest on the block, in India, I believe, has been very fast on the block, because we got all the technology equations right. This had happened 2 years back, we would not have a bandwidth. 2 years back, cost would have been prohibitive. Today, for the digital super cycle, we have got the bandwidth, We've got the lowest cost platforms in the world. Adaptability. I think the people have reset their mindsets much quicker than what I would have thought. So if there's one learning that I've taken, the reset of the mind has taken much quicker than what I would have thought of. I like to use the phrase, the reset of the mind has happened in the blink of an eye. And this bodes very well for us as we now drive a new India, fully Atmanirbhar, to a new future.
What a wonderful way to summarize your thoughts. Mr. Kamath, an absolute pleasure and a delight to have you on the show. Thank you for your time, and we look forward to much more of you going forward.